Welcome to Credit Training Program.
Chapter 2: Understanding Business Borrowing Needs. To serve your customer well, you must understand their business well enough to identify and understand the business's needs, and then communicate those needs to your institution's internal credit unit. The greater your understanding, and the greater your ability to communicate that understanding, the better your institution can respond to the customer's request. Unit 1: Financial Statement Fundamentals. When you complete this unit, you will be able to explain the differences between cash and accrual accounting, identifying the information provided on a balance sheet and income statement, and the order in which that information is presented, recognize links between the balance sheet and the income statement, and identify accounts on both statements that would be affected by common business transactions. Basic accounting principles. Accounting is a business language, a means of communicating the facts of financial condition and activity of a business. Accounting language is based on a set of principles that are general enough to be applied to a wide variety of businesses. Financial statements provide two basic types of information: balances in various accounts, such as inventory or amounts owed to lenders, at any given point in time, for example, the amount of cash a company has at the close of business today, are shown on the balance sheet. Activity that occurred during a period of time, for example, the value of merchandise sold since the last statement was prepared, is shown on the income statement. Note: a balance sheet presents a picture of the company's financial condition at a fixed point of time. An income statement reports the results of the company's operating activities during a period of time. Note: a balance sheet presents a picture of the company's financial condition at a fixed point of time. An income statement reports the results of the company's operating activities during a period of time. Cash basis accounting. The cash basis accounting reports operating results only when cash is actually received or paid for an activity. Using the cash basis of accounting, company records revenue only when cash is actually received from customers, and expenses are recorded only when cash is paid out. Accrual basis accounting. The accrual basis of accounting records revenue at the time that it is earned, when goods have been sold or services performed. Expenses are reported in the same period as the revenues they help to produce. When using accrual accounting, a company must decide which income and which expenses are to be recognized and used to calculate profit for any given financial period. Major balance sheet and income statement categories. Balance sheet terminology. The balance sheet summarizes what a company owns and how the company financed it: internally, equity, or externally, debt. The balance sheet generally shows assets on the left, and liabilities and equity on the right. A fundamental accounting principle is that the total amount of the assets must always equal the combined total of the liabilities and equity. Assets equals liabilities plus equity. Asterisk assets are all goods, equipment, and supplies owned by a company. Assets are displayed on the balance sheet in order of liquidity, with the most liquid assets first and the least liquid last. There are two major categories of assets: current assets and non-current assets. Asterisk current assets are those assets used in the operating cycle. The rule used by accountant is that a current asset will convert to cash in the course of 1 year or one operating cycle, if longer than 1 year. Current assets include cash, money in the company's bank account, and petty cash funds. Accounts receivable, money owed to the business by its customers, usually in the form of customer accounts that are billed and paid off regularly. Some businesses that sell goods on an installment basis will carry accounts receivable for several months and charge interest. Inventory, goods or materials bought by a company to sell or to use in preparing a product or service for sale. Inventory includes all raw materials, work in process, and finished goods. Asterisk non-current assets include assets that are used for more than one operating cycle and assets that do not convert to cash within 1 year. These assets may be used over several periods to generate profits. Non-current assets include fixed assets, property, plant, and equipment. the tools, real estate, machinery, and equipment used by the company to carry on its business. Anything classified under this heading has a useful life of longer than 1 year. This account may also be referred to as plant and equipment or as buildings, machinery, and equipment. Intangibles. This category includes such items as copyrights, patents, and goodwill. Items that have no physical substance yet represent an asset acquired by the company. Asterisk liabilities are amounts owed to other companies or individuals. There are two major categories: current liabilities and non-current liabilities. Current liabilities are liabilities that have appeared as a result of operating cycle activities, and must be paid within 1 year following the balance sheet date. Current liabilities include accounts payable, money owed by the company for the purchase of goods it buys on account. Short-term bank debt or notes payable, amounts borrowed from a financial institution for less than 1 year, usually 30, 60, 90, 180 days. This account can also include outstanding loans that are due within 1 year. Current portion of long-term debt, the portion of long-term debt principal that is due and payable within 1 year. Accrued expenses, expenses accumulated for goods or services that have been received but not yet paid for in cash. Asterisk non-current liabilities, generally are debts that are to be paid at times further in the future than 1 year from the balance sheet date. Asterisk owner's equity is the last major account heading on the balance sheet. There are two major subheadings. Paid in capital. These are amounts that are invested in the business by its owners. Generally, owners may contribute additional money to the business on this basis at any time. Retained earnings. This is the accumulation of profits or net income during the entire life of the business's operations, less any withdrawal of profits made by the owners during that time. The balance sheet. Assets equals liabilities plus owner's equity. Cash. Account receivable short inventory, current assets, current liabilities. Non-current assets accounts payable term debt current portion, limited accrued expenses. Fixed assets long-term debt intangibles, non-current assets. Non-current liabilities and owner's equity. Paid in capital retained earnings. Income statement terminology. The income statement expresses the company's sales and expenses during a specific period. You will usually find the following accounts listed on the income statement. Sales or revenue, all receipts of a company that result from the transfer of ownership of goods from the company to another party or from the delivery of services to another party or from the delivery of services to another party. Remember that the amounts shown as sales or revenue do not always equal cash. Cost of goods sold. A company classifies all goods and services acquired for later sale as inventory. When the company does sell goods, the amount that was originally paid for the goods is recorded in the income statement as cost of goods sold and is subtracted from inventory on the balance sheet. Gross profit. The difference between sales and cost of goods sold. Operating expenses. The expenses of operating the company, including rent, salaries, telephone, advertising, and other expenses not included in the cost of goods sold.